Hi everyone, my name is Corey Stackhouse. I hope you're having a wonderful day today. Before I begin this video, I want to put some disclosure at the beginning of this. Please talk with your trusted financial advisor, insurance agent, tax advisor, attorney, whomever you need to for this applicable idea I'm about to share today. I just wanted to have this quick video because it's been coming up in my office quite a bit as of late and wanted to share this information with the world in hopes that maybe they have some more arrows in their quiver. But let's begin. Today's concept is going to be a long-term care annuity strategy idea. So where we're going to begin is we're going to begin with this first category of this must be after-tax money that we're going to be utilizing in this idea. So it's not going to be done inside of an IRA or a 401k or a Roth or anything of that nature, at least for this particular product that I'm not going to list off by name. But how this one works is, let's assume, knock on wood, you never need long-term care coverage. That would be wonderful. If you did not need long-term care coverage, think of this idea as kind of a long-term fixed rate payment, similar to a CD. I can't call it a CD because of insurance purposes, but it looks and acts and feels the same, but there is an adjustable rate from year to year that the insurance carrier can change if weather permitted, if that makes sense. Assuming, again, you never need long-term care for anything, that is wonderful. Just think of this as like a certain boring allocation of your investment strategy that's going to earn a fixed rate of return. In the event that you or a spouse, I guess I like to point out step number 4 in line with step number 3 at the same time, this policy would triple 3x in value in the event you needed it for long-term care in the future, husband or wife. So we'll give an example here with numbers. So let's assume husband and wife put in $250,000 after-tax money today. If interest rates stayed at 5% per year, 5 years down the road, that policy is going to turn into $319,000 and some change. In the event, hopefully, neither of them need long-term care, but in the event that one of them does or both of them, how this policy would work is, again, this would triple in value to provide you a total long-term care benefit pool, if you will. So with that, this is going to provide 90 months worth of a benefit pool to the husband and wife. So with that, an example, let's assume the husband needs to go in for 24 months. And then is able to come back out, and then they're both fine and dandy, and then in the future somebody else needs to go back in. They still are going to have a total of 90 months less the 24 months that they have already spent, if you will. So that means that they're going to have 66 months left available to them. So again, this is in joint name. And then lastly, the most important part of this, which is probably the biggest reason that I think a lot of higher net worth individuals are considering these types of policies, is the tax advantages of it. So this policy that I'm talking about right now, you have to be licensed to sell long-term care in addition to investments and those types of things. So the benefit pool that you're going to receive, this $10,000 a month from this policy, is tax-free. So that is such a big deal, because let's compare it to a simple example of investing in a stock in an after-tax account versus an annuity in this type of account. So let's act like we bought $250,000 worth of an investment today, and 5 years from now, we manage to quadruple it somehow. That isn't going to be happening on a regular basis, but maybe it does. And it turns into $957,000 and some change 5 years from now. Same thing happens with this long-term care policy scenario I just went over with you. They both are equal 5 years from now. Well, whenever you are paying for your long-term care month by month, and you're pulling $10,635 a month from each of these side by side, one of them, you will start coming across taxes needing to be paid on all those gains that you have if you're talking about the stock account. So you're going to have to pay taxes on $700,000, give or take. Depending on your tax bracket, we could talk anywhere from 10 to 20%, maybe even 30, depending on who you are. But if that is going to be the case, then you're going to pay on $700,000 a gain. Let's just assume 20% rate of return. You're going to pay an extra $140,000 in taxes, whereas this policy would save you that in the event you needed it for long-term care purposes. So again, just a very short video this week. I wanted to give you guys an idea that it's been coming up quite a bit in the office. There are some other fine details that you would need to go over if you were going to talk with any advisor or insurance agent about these types of products, like surrender periods and underwriting and so on and so forth. But again, I hope this idea is valuable. Just wanted to share it with the world. If you would like to talk with anybody because you don't have somebody you would like to talk with about this, we are happy to do so at Stack Enterprises. We are a virtual financial advisory firm and insurance agency. I am a certified financial planner, and I've been in the industry for, a little over 9 years now. So come across quite a few scenarios and would love the opportunity to come across some more unique scenarios. So I look forward to talking with you guys again soon next week. Or if you feel like giving our office a call, the phone number is 6604, or check out our website. We've got our calendar live on there at www. So have a great day. Thanks.